The top one that comes to mind is to invest based on short-term past returns, or to invest based on a very myopic view. For example, just looking at YTM. Okay, now where is that YTM coming from? Well, like I mentioned, YTM could come because my bond price has fallen a lot in value. Why has it fallen? Sometimes the market knows more than you. The bond price could be falling because it's about to fall off a cliff. Right. So the market knows that there is a credit event going to happen in this portfolio. And so it's selling off, thereby raising the YTM. And I, as an investor, unfortunately, who is unadvised or who doesn't have the required resources or knowledge, I'll just see, oh, wow, YTM of 13%. Okay. Without realizing that that comes with an immense amount of risk. So I think that's the first mistake, judging a fund based on a single parameter and not looking out for any red flags. The second mistake is to think of debt funds as an FD. A lot of people do that. They say debt funds and FDs are the same. Couldn't be farther from the truth. Debt funds and FDs have to be approached very differently in terms of the investing mindset, in terms of the understanding required, in terms of the objective. Okay. And I think the third thing would be to, again, like I mentioned, try and chase that incremental 1 or 2% return by taking very high amounts of risk in a debt fund for a short-term goal. It just doesn't make sense. Be happy with a 7%. Don't chase that 8.5%, 9% for a 3-year goal, because it comes with a very high amount of risk, I would say. Sometimes the way those risks play out is unimaginable. So I don't think it's worth it. I think these are the top 3-4 mistakes. And I'll also add another mistake. Staying invested in a debt fund for way too long is a mistake. I have seen investors coming in saying, let's keep it in a debt fund for a couple of years, फिर देख लेंगे. And then that dekh lenge never happens. And then 6 years later also you're sitting in that same debt fund earning a pittance, 7.5%. 10 years later also you're earning 7.5% when the compounded return could have been 11, 12%. And with every passing year thereafter, you're losing out on a massive wealth creation opportunity. So again, so goal alignment and goal linking helps. If I align my investment to a 10-year goal, I'll automatically come back to it and question, is this the right fund for me to be in? Is this fund the right fund for a 10-year horizon? So don't stay invested for too long in a debt fund, unless, of course, it's part of a structured asset allocation and you already have a very large corpus. Like I said, the two scenarios are two completely different scenarios. One where I've got my corpus in place and one where I'm looking to build my corpus. The two scenarios are 100% different.
Right. So Anirudh, thanks so much for joining us today and sharing your valuable insights on how do we select the right fixed income funds. Some of the important points that I could make a note of, though we discussed a lot, you highlighted return of capital is more important than return on capital.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.